Welcome back to the deep dive. Today we are focusing on something that really is the mathematical architecture of your financial life.
It is. We're talking about a single three-digit number that can dictate the cost of your car, your ability to get a house, and, believe it or not, sometimes even your ability to land a job.
It's the ultimate gatekeeper in the modern economy, and it feels pretty mysterious to a lot of people.
It does. And that's why we're doing this, a really intensive deep dive into credit history, the reports, and that enigmatic credit score. For so many, it's like this shadowy figure making these huge decisions.
But it's not magic.
Not at all. We've gone through the research, the actual laws, the proprietary algorithms to, pull back the curtain.
Absolutely. We've got a heavy stack of sources right here detailing everything from the Fair Credit Reporting Act to the actual FICO weighting formula. So our mission for you, the listener, the learner, is pretty simple.
We won't give you a shortcut.
Exactly. A shortcut to understanding this whole apparatus. We want you to walk away from this not just knowing your score, but really getting the mathematical leverage points that let you manage it. And crucially, understanding the tangible impact it has every time you apply for, anything.
Okay, let's get into it.
Okay, let's unpack this. Before we get into all the percentages and the risk models, we have to clear something up. People tend to use three terms interchangeably: history, report, and score.
And they're not the same thing at all. They're fundamentally distinct elements.
Let's start at the bottom layer. Credit history. What exactly is that?
The credit history is the foundational record. Think of it like a raw, chronological diary of your life as a borrower.
Just the facts.
Just the facts. Did you pay on time? Did you default? Did you borrow too much against your limit? It's the factual timeline.
Right. So that's the activity. And when you take all that activity and compile it, you get the credit report.
Precisely. The credit report is the document that comes out of that history. And the data is gathered from, everywhere. Banks, credit card companies, collection agencies, sometimes even government records for things like public judgments.
So it's the comprehensive, organized list of every account, every balance, every payment you've made or missed.
That's it.
And finally, that brings us to the infamous three-digit number, the credit score.
The score is the numerical output. It's what you get when a complex mathematical algorithm in the U.S., that's usually the FICO model, is applied to all that raw data in your report.
And it's so critical to remember what its function is.
Yes. Its only purpose is to predict future delinquency.
That's it. It's not judging your character.
No, it's just assessing the statistical probability that you're going to be a risk in the future.
That distinction is paramount. History is what you did, the report is the document of what you did, and the score is the math predicting what you'll do next. So how do lenders actually use this thing?
Okay, so when you apply for credit, a mortgage, a car loan, a credit card, the lender sends your information to one of the credit bureaus, Equifax, Experian, or TransUnion.
And they're trying to figure out two things about you.
Two things. The first one is pretty straightforward.
Your ability to repay, which is mostly just your income, your job, that kind of thing.
And the second, which is where this three-digit score comes in, is your willingness to repay.
And that's all based on the track record in the report.
Entirely. Is there a history of consistent, on-time payments? Or is it inconsistent? That track record is what signals willingness.
And our research really zeroed in on what breaks that signal. It's not about, say, paying extra. It's all about not missing payments.
That's such a crucial insight. If you overpay 1 month, the system doesn't care. It doesn't see that as an offset for a payment you missed 6 months ago.
No bonus points for being good.
No. The system is entirely geared to penalize inconsistency. It doesn't reward these sporadic bursts of financial health. It rewards sustained, almost boring consistency.
So the moment a payment is late.
The risk model reacts, and it reacts disproportionately. Because statistically, a missed payment, especially a recent one, is the most powerful predictor of a future default.
That really sets the stage perfectly. Because if this whole system is built on data, we have to ask, how good is that data?
Which brings us to Section 1, the accuracy problem and the regulations designed to police it.
This is a huge point of tension. If you ask most people, they'll say credit reports are just riddled with errors.
Right. The consumer perception is that they're full of incorrect balances, payments marked late that were on time, even accounts that aren't theirs.
But the industry view, at least according to the sources we looked at, presents a totally different picture.
A very different picture. The credit bureaus maintain pretty rigorously that their data is highly accurate. They'll
Wow.
cite these massive internal studies. One of them looked at 52 million credit reports to claim a minimal error rate.
And when they testified before Congress, the industry reps were specific. They said less than 2% of reports that led to a consumer dispute actually had data deleted because of a verified error.
Which sounds incredibly low. It's a staggering contradiction to what you hear from people every day.
It is, but let's connect that number back to the scale of the system because the tension is still there.
Hmm.
If you've got, 200 million active credit reports in the U.S. alone, 2% is still 4 million reports with errors bad enough that they had to be deleted.
That's a great point. Whether the error rate is technically high or low, the impact of an error is so significant that Congress felt it had to step in.
And that led to the laws that govern the consumer dispute process in the U.S.
Right, the Fair Credit Reporting Act, or FCRA.
So if a listener finds an error on their report, let's say a late payment they know they made on time, what's the legally mandated process for getting it fixed?
Okay, so once you, the consumer, officially file a dispute, the credit bureau is on the clock. They have a legal mandate of 30 calendar days to investigate and verify that piece of data.
What does an investigation entail? They don't just take your word for it.
No, they have to contact the data furnisher. That's the bank or the creditor who reported the information in the first place. That bank then has to confirm or deny the accuracy of the item you're disputing.
And if they don't confirm it within that 30-day window,
Or if they confirm it's incorrect, then the credit bureau is required by law to either delete or correct the information immediately.
and you get notified of what happened.
Yes, they have to tell you the outcome.
And the sources suggest that, despite all the anxiety around this, the process is often pretty efficient.
It is, surprisingly. The data shows over 70% of these disputes are actually resolved within 14 days, much faster than the 30 days they're allowed.
And the Federal Trade Commission even noted that people seem pretty happy with the results. One big bureau found 95% of consumers who filed a dispute were satisfied with the outcome.
Which raises an interesting question.
If 95% are satisfied and 70% are resolved in 2 weeks, why does this perception of, inaccuracy and total frustration persist so strongly?
I think it's likely because the stakes are so high.
Right.
When an error does slip through, its impact can be catastrophic. It could be the thing that stops you from getting a mortgage, or it could cost you a job. It's the severity of the consequences, I think, not necessarily the frequency of the errors, that fuels all that public anxiety.
And the stakes have never been higher. Which brings us to the importance of the credit report in determining the actual cost of your life.
Yes. If we connect this to the bigger picture, the report's influence has just exploded because of the widespread adoption of risk-based pricing.
What does that mean exactly?
Well, before scoring models became universal, lenders might have had broader criteria, maybe more standardized terms for everyone.
But now it's intensely personalized.
It is. In many, many cases today, the credit report and the score that comes from it is the sole element used to determine your annual percentage rate, your APR.
And not just the APR.
No, the grace period on a credit card, other contractual obligations of the loan. It all comes from that one number.
So this number doesn't just grant you access to credit, it determines the cost of that access.
Precisely. The difference between a high score and a low score could mean you're paying 5% on a car loan or you're paying 25%.
We're talking about a difference of thousands of dollars in interest over the life of the loan.
Exactly. A low score doesn't just put you in a high-risk category. It means you are financially subsidizing the risk of everyone else in that category by carrying a dramatically higher rate.
And understanding that link between the score and the cost is it's foundational.
It is.
Which is the perfect segue into the formula itself. This is the central piece of this deep dive, the mathematical engine behind the score. We're going to break down the FICO model.
Which is the acknowledged standard in the U.S., Canada, and a lot of other places.
The general range for a FICO score is 300 to 850. And while there are different versions of the model for, say, mortgages or auto loans, the core architecture is always built on 5 factors with fixed percentage weights.
And these weights are, they're non-negotiable facts about how the model works.
Let's start with the biggest one, the most critical factor, contributing a colossal 35% payment history.
This is the foundation. Absolute consistency matters most here. Any record of negative information will just drastically lower your score.
By negative information, we mean
We're talking bankruptcies, accounts and collections, charge-offs, foreclosures, or just any late or missed payments, even if it's just 30 days past due.
And this is where the research gave us some really essential nuance. FICO doesn't treat all of these negative items equally within that 35%.
No, it weighs three things: the severity, the age, and the prevalence of the negative items.
Okay, let's break that down. Severity.
A 30-day late payment is bad. A 60-day late payment is worse. And a 90-day late payment is catastrophic to your score. The model assigns this sort of exponential risk to how long you've been delinquent.
It sees a 90-day late as a signal of extreme financial stress.
Exactly. Now, what about the age of the item? How does time heal the score mathematically?
This is a huge one. The sources confirm a crucial distinction. More recent negative items are considered much worse than older ones.
The model has what you could call a memory decay function.
Right, so a 30-day late payment from 6 months ago might carry 10 times the negative weight of a 30-day late from 5 years ago.
And after 7 years, most of these negative items, late payments, collections, charge-offs, they just disappear from your report entirely. Their weight becomes zero.
So if a listener is going through a tough time financially, the absolute #1 priority has to be preventing new, recent delinquencies.
Absolutely, because those are the ultimate score killers. The age factor means you can recover, but it's slow. It requires sustained, recent, perfect behavior to offset the severe negative weight of that new problem.
Okay, moving on to the silver medalist, contributing 30% of your score. Debt, or more accurately, the amount of debt you owe.
This is where strategic management can really pay off. This category is dominated by one single pivotal metric: the revolving utilization ratio.
Let's break down the math on that. What is it?
It's a simple calculation, but it's powerful. You divide your total credit card balances by your total credit card limits.
So if you have $10,000 in available credit across all your cards and you're carrying a $1,000 balance, your utilization is 10%.
And the research is crystal clear. The higher that percentage goes, the lower your score will be.
Why? What does it signal to the model?
It's a direct risk indicator. If you're maxed out using 95% of your available credit, the scoring model sees you as high risk because you have basically no financial cushion left.
And the research provided some really specific guidance on this. What's the optimal range for utilization?
To maximize your score in this 30% category, you really want to keep your utilization ratio below 10%.
Below 10.
Yes. Once you cross the 30% threshold, the scoring penalty becomes pretty significant and sharp. But the good news is you can recover from high utilization quickly, unlike a late payment. But yeah, below 10% is the gold standard.
This directly connects to that common warning about closing old credit cards. Someone pays off a card, and they think they're being responsible by closing the account. Why does that often hurt their score?
Because it blows up their utilization ratio.
Mm-hmm.
When you close that account, you instantly reduce your total available credit limit. That's the denominator in the calculation.
Right.
So unless you have zero balances on all your other cards, your utilization percentage automatically goes up, which often leads to a score drop.
It's all a ratio game. Keep the limits high and the balances low.
Exactly. The best advice is usually to keep those old paid-off cards open. Put them in a drawer, use them for a small purchase every 6 months to keep them active, but keep that credit line open.
Within this debt category, the sources break down 3 distinct types of debt that the models look at.
Right. First and most important is revolving debt. This is your unsecured credit cards, retail cards, gas cards.
And it's most important because it's not tied to an asset.
Exactly. It represents the highest risk to the lender, so it carries the most weight in that utilization calculation.
Okay. Second is installment debt.
This is your fixed term, fixed payment stuff, mortgages, auto loans, student loans.
How important is that?
It's definitely considered, and managing it well helps your score, but it's a distant second in importance to revolving debt. The key is a collateral. The loan is secured by a house or a car, so you have a very strong motivation to keep paying. The risk is lower.
And finally, a less common type, open debt.
Right, like some traditional charge cards where you have to pay the balance in full every month.
How does FICO see that?
Well, older FICO models sometimes looped it in with revolving debt, which was a problem. But the good news is that the newer FICO versions tend to exclude open debt from the revolving utilization calculation. That's a good nuance to know.
So we've covered the 2 heavy hitters. That's 65% of your score right there. Let's move to the third factor, which contributes 15%. And that is time in file or the age of your credit.
Simple concept here. Longevity signals stability. The older your credit report is, the more data points the model has to work with, and the more stable you look as a borrower.
And the algorithm actually makes 2 distinct age calculations here, right?
Correct. First, it looks at the age of the entire credit file, which is set by the date opened of your single oldest account.
Okay.
And second, it calculates the average age of all your accounts, both open and closed, that are still on your report.
Which again reinforces that advice about not closing your oldest card.
It's a double whammy if you do. You hurt your utilization, and you could drag down your average account age, hitting two major scoring categories at once.
A compounding negative effect.
Definitely. Stability and age are your best friends here.
Okay, next up, contributing 10% is account diversity.
This one is pretty straightforward, but it's important for getting into those really high score ranges, like 800 plus.
So what are they looking for?
Lenders just want to see that you can successfully manage different kinds of credit. If you only have credit cards or you only have a student loan, you haven't really demonstrated comprehensive financial maturity.
So having a mix some revolving debt like credit cards and some installment debt like a car loan or a mortgage proves you can handle different financial structures.
It proves you get fixed payments, you get interest schedules, you get revolving minimums. It just rounds out your profile and makes you look like a more reliable borrower.
Got it. And that brings us to the final 10%, the last piece of the FICO formula, and that's the search for a new credit, which is mostly measured by inquiries.
Here's where it gets really interesting, because not all inquiries are created equal.
Right. An inquiry just means a company requested your credit file, but there's a huge difference between a soft inquiry and a hard one.
Let's start with the one that doesn't matter for your score. The soft inquiry.
Zero effect.
Zero effect. They're visible to you if you pull your own report, and they stay on there for about 6 months, but they are completely invisible to potential lenders and to the scoring models.
So what are some examples of these, the ones we shouldn't worry about?
Well, there are a few big ones. First, those pre-screening inquiries for all the pre-approved credit card offers you get in the mail.
Okay.
Second, when one of your existing creditors does a routine account check on you. Third, and this is important, when you check your own credit report.
So checking your own score doesn't hurt your score.
Ever. And finally, inquiries for things like employment screening, getting an insurance quote, or setting up utilities, all of those are benign.
Now for the critical ones, hard inquiries. These are the ones that can actually cost you points.
A hard inquiry is visible to lenders and to the scoring models. And it's triggered when you, the consumer, are actively applying for a new line of credit or a loan.
What's the actual damage from one hard inquiry? Is it a 50-point drop?
Oh no, not at all. The impact is generally much smaller. A single hard inquiry might cause a drop of just a few points, if anything at all, and its effect fades pretty quickly, usually within a few months, and it falls off your report completely after 2 years.
So the real danger isn't one inquiry, it's a whole bunch of them at once.
Exactly. The scoring model sees a cluster of hard inquiries in a short period as a sign of potential financial desperation.
It looks like you're scrambling for cash.
Right. If you apply for 5 credit cards in 1 month, the model sees that as high risk, and that can cause a more noticeable drop in your score.
But the research points out a very important exception to this rule, which is a huge benefit for people shopping for big loans.
Yes, this is the rate shopping safe harbor. The model is smart enough to know that when you're buying a car or a house, you need to compare rates from multiple lenders.
So it doesn't penalize you for that.
It doesn't. FICO models will treat all similar hard inquiries, say for a mortgage, that are made within a certain time window, usually 14 to 45 days, as if they were just a single inquiry.
That is such a critical piece of information. So you can shop around for the best mortgage rate without wrecking your score.
You can, and you should.
Okay, so that 353-151-010 split is the blueprint. But now that we know how the number is calculated, we need to get into the practical side of things. How do you actually access your report and fix the errors we were talking about earlier?
And that brings us to the legal framework for access, which in the U.S. is governed by the Fair Credit Reporting Act, the FCRA.
The FCRA covers the big three we all know, Experian, Equifax, TransUnion, but its reach actually extends much further. It covers what are called specialty agencies.
And this is an area that's often overlooked by consumers. These specialty agencies cater to very specific clients, and they collect very specific data.
Like what?
For example, there might be a specialty agency that only collects data on payday loan behavior, or one that focuses on medical debt, or even one that tracks landlord-tenant disputes and eviction records.
And why do these matter?
Because, even though they're niche, the FCRA says they have to follow the same rules of accuracy and consumer access. And that data can still be used against you by, say, a landlord who's deciding whether or not to rent to you.
And the single most important requirement the FCRA places on all these agencies, big and small.
It mandates that they all must provide you with a free copy of your own report once per year upon request.
This isn't a perk. It's a federally guaranteed right.
It's your right to see the data they have on you and check it for accuracy.
Now let's look globally for a second. We notice that Canada, for example, approaches this with a really heavy focus on education.
They do. In Canada, the government itself offers this free, extensive publication called Understanding Your Credit Report and Credit Score.
So they're trying to empower consumers directly.
Yes, explaining the codes, giving strategies for building credit, clear guidance on identity theft. It's a much more public education-focused model.
And then in Europe, we see some countries that integrate their central bank right into the system, which is a huge difference from the private sector model in the U.S.
Right. Take Spain. Their central credit register is maintained directly by the Bank of Spain. So individuals can get their reports for free, online or by mail, from a central government body.
Which some would argue provides a higher degree of oversight.
It's certainly a different approach.
This global view is really illuminating because it highlights one of the major systemic flaws in the international financial system, the immigrant credit challenge.
This is such a harsh reality. The research confirms that your credit history basically has no international portability. An excellent credit rating in, say, Germany or Australia means almost nothing when you move to the United States.
And even if it's the same company, Equifax Canada doesn't share data with Equifax US.
That's the core of the problem. An immigrant who has diligently managed their credit for 20 years in their home country gets here and has to start their financial life completely from scratch.
They have no local credit history.
Which means an immediate inability to access good rates or even get approved for major things like a mortgage.
It creates these immediate practical difficulties. You might have a high income, so you meet the ability to repay side of things, but you have zero data for willingness to repay.
So you get locked out of standard credit cards or reasonable mortgage rates for years. The workaround is often things like secured credit cards, where you have to deposit your own money as collateral.
We did find one notable exception to this international wall, though.
Yes. While it's uncommon for lenders to consider international history, American Express is specifically noted in the sources as one company that can sometimes transfer a credit card account from one country to another.
Which would be a huge lifeline.
A critical lifeline for establishing local history right when you arrive.
That's a great strategic hack for anyone moving internationally. Now, let's pivot from people starting fresh to people who are struggling. We need to talk about what's called adverse credit history and its significant consequences.
Adverse credit goes by a lot of different names in the industry. You'll hear subprime, non-status, impaired, poor, or just bad credit.
But they all mean the same thing.
They all mean a negative rating that is considered undesirable by most lenders.
And it's caused by a concentration of those negative items we talked about. Too many late payments, collections, public judgments, that sort of thing.
It's worth remembering why the scoring system was even adopted in the first place. Before these automated scores, evaluating loan applications was a manual, slow, and often inconsistent process.
And the sources say the shift to scoring brought two huge benefits.
Right. First, it made credit available to more people. And second, it lowered the cost of processing applications. It was a standardized, rapid, and at least in theory, a without prejudice way to assess risk.
Because at its heart, the score is just a risk gauge.
Exactly. It's just comparing your behavior to the behavior of millions of other debtors to predict how likely you are to default. When your history triggers that low score, that's what the financial world calls adverse credit.
The most obvious consequence is a huge drop in your chances of getting approved for a loan. And if you are approved, the terms are often financially punishing.
It goes right back to that risk-based pricing we discussed. An adverse credit history directly leads to a significantly higher interest rate.
Because the lender is hedging their bets. The extra interest you pay is designed to offset the higher statistical default rate for people in your score range.
Precisely. But the consequences, especially in the U.S., go way beyond just loans. The FCRA allows entities with a permissible purpose to see your information.
And this is a critical point for our listeners. Denial or bad terms can extend to major life necessities: insurance, housing, and employment.
Let's start with employment, because that's the one that often surprises people. A 2013 survey showed that employer credit checks were actively keeping people from getting back into the workforce.
What did it find?
It found that 1 in 4 unemployed Americans was required to undergo a credit check when applying for a job.
And why would an employer care about your credit?
For certain roles, especially in finance or jobs with access to sensitive data, a poor credit history is seen as a sign of potential irresponsibility or worse, a vulnerability to things like fraud or bribery.
Now, there are regulations. Employers have to get your written permission first, but it's hard to prove you were denied a job because of your credit history.
It's a very opaque system, and it creates this huge hurdle for people trying to recover financially. It's worth noting, though, that some states, like California and Illinois, have passed laws restricting the use of credit checks for most jobs.
What about housing? Can a landlord deny you an apartment because of a low score?
Absolutely. Landlords use credit reports and scores all the time to predict the likelihood of you paying your rent on time.
A high score suggests you're reliable.
A low score with a recent history of collections or non-payment suggests you're a high risk, which can lead to a denial or a demand for a much higher security deposit.
Before we move on, let's just clarify who makes the final call here. The credit bureaus don't decide if your history is adverse.
That's a key point. That decision rests entirely with the individual lender or creditor. They use their own internal proprietary guidelines.
Which are usually secret.
For competitive reasons, yes. So a score that's perfectly fine for lender A might be too low for the risk profile of lender B.
But if they deny you credit, they can't just say no.
No. In
Right.
the U.S., the creditor has to immediately give you the specific reasons for the denial, and they have to provide the name and address of the credit reporting agency whose data they used.
Which lets you circle back, get your free report, and dispute the exact information that was used against you.
It closes the loop.
Okay, we have spent a lot of time on how to manage this system properly. Now we have to look at the dark side. How this incredibly complex, data-heavy system gets exploited, both from the outside, by criminals, and from the inside, by the powerful agencies themselves.
You know, the system is designed to create trust, but because all this valuable data is so centralized, it's inherently vulnerable. And the research points to several well-known ways people exploit those vulnerabilities.
Let's start with the external abuses. One technique the sources cite is churning.
Churning is basically exploiting new credit card offers over and over again. People will open accounts just to get huge sign-up bonuses or 0% APR periods, and then they'll close them or stop using them almost immediately. It's an industrialized way to maximize rewards.
Then there's something called rapid-fire credit applications.
This one is riskier. It's where someone applies for a whole bunch of loans or credit cards in a very short amount of time, gambling that they can get approved for a lot of credit before all those hard inquiries hit the bureaus and their score plummets.
The sources also talk about piggybacking. What's that?
Piggybacking is using authorized user status on someone else's good credit account. Historically, parents would do this to help their kids build credit.
But now it's been commercialized.
It's become a black market.
Yeah.
People with excellent, long credit histories will sell access to their accounts, they call them trade lines, to people who want an instant score boost by association.
And then there's the most insidious external abuse, fabricated files.
This is straight-up identity fraud. Criminals have found ways to exploit regulatory blind spots to create entirely fake credit files within the system. They build up these fake identities, get high credit limits, and then take out huge loans they never intend to repay.
And the biggest vulnerability of all is just the sheer concentration of data, which was laid bare by those massive data breaches.
The Equifax breaches in 2017 were seismic events. They just exposed the incredible risk of having all this sensitive consumer data names, addresses, social security numbers centralized in just a few private companies.
It proved that the gatekeepers themselves were prime targets.
Absolutely. But the fraud doesn't just come from the outside. The sources we looked at highlight that fraud can also be committed on consumers by the credit reporting agencies themselves.
And that just destroys consumer trust.
It completely breaks the model of an unbiased system. We have a powerful documented example of this from 2017. It involved huge fines from the Consumer Financial Protection Bureau, the CFPB.
Right. Equifax and TransUnion were fined a combined $23.3 million for deceiving customers about the cost of their own services. How are they deceiving people?
They were caught selling credit monitoring services directly to consumers. These services were advertised at a really low price, like $1, to get people to sign up.
But that wasn't the real price.
No. Consumers were unknowingly being enrolled in these expensive auto-renewing subscriptions, sometimes getting billed to $200 a year. It was a clear-cut case of intentional deception.
They were exploiting consumer anxiety about the very data they're supposed to be protecting.
Exactly. The agencies tasked with being the unbiased arbiters of your financial life were actively acting as predators for short-term profit.
That is deeply troubling. This has been an incredibly detailed deep dive. It's probably time to summarize the essential takeaways for the listener.
I think so. First, the foundational difference. The credit report is your history, the document of your past. The credit score is the mathematical prediction of your future. Never confuse the two.
And strategically, if you want to maximize that score, the FICO formula is your map. Payment history at 35% and debt utilization at 30% are the kings.
Keep that utilization below 10% if you can, and just never ever miss a payment. That's more than half the game right there.
And we also emphasized your legal rights. The FCRA guarantees you a free annual credit report, and it legally mandates that 30-day process for disputing errors. Knowing those rights is your best defense.
It is.
So what does this all mean? I mean, understanding this system is just fundamental. This 3-digit number dictates the cost of living and your access to major life opportunities, housing, insurance, employment.
It really does. It determines whether you get the standard rate or the rate that's designed to offset your risk of default. This knowledge is what empowers you to control that access.
And this brings us to our final thought, something for you to mull over after everything we just discussed.
Okay, so credit scores were originally adopted with this promise of being a rapid, standardized, and theoretically an unbiased assessment of risk. A system without prejudice.
Wow.
But we've documented all these significant issues: lingering data inaccuracy, the system's vulnerability to fraud, and critically intentional deception and abuse by the credit bureaus themselves, the ones who run the system.
Which led to multi-million-dollar fines.
Right. So given these documented failures and biases, to what extent can a purely mathematical algorithm truly assess something as human as willingness to repay a debt? And how does the current system uphold that original promise of being without prejudice when the gatekeepers themselves have been proven to act as predators?
That is the question worth mulling over.
A powerful thought. Thanks for diving deep with us.
We'll see you next time.